How a company is financially structured. Meet Arthur. Arthur works for himself. He is known as a sole trader. Arthur decides to go into business with Ben. They agree to pool the income they earn, deduct any costs, and share anything left over on an equitable or predetermined basis. They have formed what is called a partnership. However, Arthur and Ben might choose to set up a company. A company is a separate legal entity. A veil of incorporation is formed between the company and Arthur and Ben, who are now the company shareholders, which limits the liabilities of Arthur and Ben to the extent of their investment. So, for example, if the company was unable to pay its debts, then the creditors to whom the debts are owed are unable to come after Arthur and Ben to pay the debts instead. This is the backbone of capitalism and allows investors such as Arthur and Ben to make investments without the risk of losing everything that they own. As the company is a separate legal entity, Arthur and Ben must appoint someone to run the business, the directors. In our example, Arthur and Ben appoint themselves to run the business. The company becomes an owner-managed business. In effect, Arthur and Ben have appointed themselves to run their business on their behalf. As the company grows, it is very successful, Arthur and Ben need to appoint Charlie and David as additional directors to help them run the business. In fact, the business is so successful that Arthur and Ben decide to step down from the board and appoint Edward and Fred to the board of directors in their place. Arthur and Ben retire to their private island. How do Arthur and Ben know whether Charlie, David, Edward and Fred, the board of directors, are doing a good job of running their company? Well, each year the board produces the annual report and accounts, or the statutory accounts, as they are required by law. These are produced by the directors and sent to the shareholders. How can Arthur and Ben trust the figures in the accounts? Well, they appoint an independent auditor to check the figures for them. Note, it is the shareholders who appoint the auditor and not the directors who merely recommend their appointment. The board of directors might be split between the executive, that's Charlie and David, and the non-executive, Edward and Fred. Together, they're responsible for formulating the strategy of the business. The executive are then responsible for executing that strategy. They will typically be full-time employees of the business and will have responsibility for the day-to-day operations of the business. The non-executive are typically part-time, usually experienced business managers and sitting on the board of a number of different companies. Their role is to provide independent advice to the executive, but also to hold the executive to account. Because even if Arthur and Ben own the company, this does not give them right of access to the boardroom. They therefore appoint Edward and Fred as the non-executive directors to hold the executive directors, in this case Charlie and David, to account, in effect ensuring that the business is run in the best interests of the shareholders, Arthur and Ben, and no one else, such as the board, staff, or creditors of the company. Let's look at the company in more detail. The company has lots of assets. Assets might include buildings, plant and machinery, cash, and stock. Staff, however, are not an asset. Despite constantly being told that staff are our most valuable asset, staff are in fact an expense as they are contracted to work for the business. The business also has liabilities. These are amounts that are owed to third parties, such as banks, loans, and suppliers who have not yet been paid. The assets less the liabilities of the business is known as the net assets. If a company was to be put into liquidation, the assets would be sold off and the money used to pay off the liabilities. Any money left over would be the net assets. What would happen to this money? It would be returned to the shareholders and so is referred to as shareholders' funds, or equity. These shareholders' funds represent the amount owed by the company to the shareholders. It is there accounted for as a liability. We don't refer to it as a liability, as the company, if it is continuing to trade, does not have to give the money back to the shareholders. And this now introduces us to the accounting equation. The accounting equation states that assets less liabilities is equal to the shareholders' funds, as we have just seen above. Thus, it should follow that assets is equal to shareholders' funds plus liabilities. This is fairly simple maths, but if you're not sure, try using some numbers to work it out on a piece of paper. Thus, assets less liabilities less shareholders' funds is zero. It is a zero-sum game. What we are looking at is the balance sheet. The balance sheet is so named because one side is always equal to or balances the other. We have shown that net assets or shareholders' funds to be a balancing figure, the bit that's left over. In fact, it is actually all amounts that are specifically accounted for. What do you think are the two main things that a company owes back to its shareholders? The first is any investment that has been made by the shareholders into the business. For example, if Arthur invests £100 into the business will show assets of £100 cash and an amount owed back to Arthur of £100, thus balancing the balance sheet. The other is the retained profit or earnings. These are the amounts that are reinvested back into the business on behalf of the shareholders. So if the company takes the £100 investment, trades and make a profit of £50, it owes that £50 back to the shareholders. If it chooses to distribute £20 back to the shareholders in the form of a dividend, then it still owes the remaining £30, which is reinvested back into the business. This will appear as part of the shareholders' funds on the balance sheet. And that is how a company is financially structured.